I'm gonna make a really bold call and tell you that Wendy's stock might be going to zero. If you've noticed, every time you drive through a Wendy's location, it seems that every single time it's less and less crowded, especially compared to companies like McDonald's, Chipotle, and even Taco Bell. So in today's video, we're going to cover why this is, how the company stands today, and what is driving me to believe that the stock might be going to zero and bankrupting the company in the following years. That being said, my name is Gabriel Osorio Mazzilli. Welcome to Invested Brew, and I'll see you on the screen. All right, so today's video is titled No More Frosties, and I'm guessing you already know why. We might not see any more summer ads for the Frosties coming out of Wendy's because of the situation that the company is undergoing right now. So before we get into it, as always, we have some housekeeping items to go over, and this has to do with the successful exits that we just had within our WhatsApp deal room. This one specifically is On Holding, ticker symbol ONON. We pitched it inside our community at just under $35 a share right before the earnings announcement, and then the stock popped to 45 and change. That's over 25% returns in a single week. Now, apart from that, we also have the ongoing TSM, Taiwan Semiconductor short play, as the AI bubble is beginning to burst and unwind. Now, this is the company that I believe will be the most affected. We made an entire video about it. You can go click on it right after you finish this one. We also have the entire pitch inside our newsletter, which is linked below this video as well. Now, that being said, if you're interested in making these sort of returns and having access to our entire valuation models, Excel analysis, and deep dive on these companies, then I invite you to check out our WhatsApp deal room. You can get 7 days for free right now and get all of the deals that we're putting on for the Invested Brew portfolio. Now let's get into today's topic. And Wendy's could go to zero, as I said, and I want to lead the way with this headline for Wendy's set up to close up to 350 locations across the United States. Now, this is not something that you do if the business is doing well and if you expect it to do even better in the coming years, being management, right? So that is just the beginning, I think, of a broader theme happening in the company. And as I mentioned in the beginning of the video, this is something you can see in real life every time you drive through a location. I don't think people have the preference for Wendy's anymore. I don't think that the volume is there as far as foot traffic and orders, right? So that can be quantified as well in the market share. Right now, Wendy's holds about 1.3% of the market share in the fast casual industry compared to McDonald's, which holds roughly 16%. And you have other names like Starbucks with 23%, with Darden restaurants 7.5, and Chipotle at 7.1. So definitely Wendy's is at the bottom of the range, right? So with this in mind, this isn't new. This has been happening for some time now. Every single quarter, Wendy's seems to be reporting less and less market share, less and less volume. And if we dig into the latest financials for the quarter that was just reported, we can see the effects that this has been having on the company financials. So as far as the United States sales, we see a 4.7% decline compared to the international sales, which rose by 3%, but that's not enough. Most of the business for Wendy's is happening within the US. So I think that, enough said about that. The volume is coming down, sales are coming down, and of course that has a ripple effect across the entire fundamentals of the business. So let's get into that next. The least of your concerns as a potential investor or current shareholder in Wendy's is the decline in sales. Because when you take a look at the balance sheet right now, you can see that 98% of the capital in Wendy's is made up of debt liabilities, right? And over 70% of these liabilities are made up of long-term debt and capital leases, which means that every single time Wendy's closes a store, that capital lease is still due. That long-term debt is still due, but revenues and earnings are going to be coming down as economies of scale contract for the business. Now, as more and more locations are underperforming, forcing their closure, those leases are also a negative return on investment item for the company. That's just not good. It's not a great setup for the company. It's not something that you want to see as far as buying a name like this, as discounted as it may be. Now, the bulls may tell you, the furrows in Twitter space and LinkedIn may tell you that this is a great buy because it is still generating some sort of cash flow. And it is. When we look at the last 12 months, Wendy's generated $238 million of free cash flow. But when you look at it as a percentage of sales, it's been coming down steadily since 2020. Now it represents 10.8%. Last year was 11.6. The year before it was 11.9. So even though free cash flow is still being generated, it represents a lower and lower share of sales. And this is got to do with a very specific item in the balance sheet, which is net working capital. You can compute this by having total current assets minus total current liabilities and the change in that item year to year, quarter to quarter. Now, as net working capital contracts, it means less free cash flow conversion, which is why you see it represent a lower and lower share of sales. That is a major headwind for the future of the business, whether it's Wendy's or any other, because now you have a pressure mounting up into the future for you to seek outside financing, right? And that has to do with debt issuance, stock issuance, and that dilutes you as a shareholder. And with lower margins, with lower market share, that just means bad news for you. And of course, your furus might tell you to buy this. Again, I'm telling you stay away from it or even short it. But before you make a decision, we have to finish this entire analysis so we can make an educated decision. Now, I'm wondering now, is there any value to Wendy's? And for that, we made a whole DCF model using some Wall Street analyst assumptions when it comes to margins and some of the revenue growth for the next 5 years. And as you can see, the terminal value for Wendy's is a negative. It's a net negative. The business isn't worth anything as it stands today, and it's only because of the total debt. Were we to remove or refinance some of this debt, then there might be some value to the company. But the way that the ratios right now stand within the balance sheet, I don't think that Wendy's is going to be able to refinance this anytime soon. Now, keep in mind, most of this debt is going to be due in 2030. So we do have some time until the real news come out, the real effects are felt. However, we don't want to wait until then to find out whether we're going to lose all our money. So again, I wouldn't recommend buying this at all. And again, I wouldn't listen to anyone that tells you to do so. Now, there's another valuation metric or methodology that we can use, and it is the so-called Buffett 5-year coupon, which is essentially a discounted coupon model treating Wendy's as a debt instrument. Considering that 98% of the company is debt, we can just take the pre-tax and pre-interest earnings of the company per share, which comes out to $1.58. We could do a future value compared to where it trades today, discounted at the discounted rate we use for the DCF model, and we essentially get a value of $4.04 a share, which is roughly half of where it trades today. So again, not even as a debt instrument does Wendy's have any value left to it for you to buy it right now. Now, when we look at the difference between Wendy's and its comparables, we could see companies like Chipotle, McDonald's, Yum Brands, Darden, and Cava. And Wendy's stands right at the bottom when it comes to valuation metrics like price to revenue, price to EBITDA, price to free cash flow, and price to earnings. Now, even on the free cash flow basis, which is the bull thesis for all of those Twitter furus out there, it's still the lowest in the group at 5%. So again, tell me why you would be buying this company. Is it the discount? Is it the free cash flow? I think that it's all wrong, and it goes back to the way that you've been taught to buy stocks. You see, most of us are taught to look for these discounted companies, the ones that are at the bottom of the barrel, and look for that deep value reposition into higher prices. Now, I'm telling you, that is an old world narrative. The way that the big banks and hedge funds trade today is the total opposite. The way you source ideas to get paid quickly and not wait years and years and years to find out whether you're going to make a profit or not is the way that everyone should be trading today, especially as we reach all-time high valuations on stocks. Now, we made a free 5-day email crash course for you. You can sign up for it in the link below this video. And on day number 4, you'll get the tools and methods necessary to switch that old world narrative around and trade or source ideas the way that the big banks and hedge funds do. I hope to see you there. Everybody that has taken it is seeing massive, massive improvements in their trading, and there's really no risk to you since it's completely free. Now, again, we see the discounts on Wendy's, and we have to figure out why the market is discounting this stock so much. And I don't think I have to touch on that again. We can see the balance sheet, we can see the declining market share, and we can see the declining store count driving those earnings lower and lower still. So let's move on into another valuation metric that we can put on. And this is based on the forward financials that we have forecasted when it comes to revenue and EBITDA, we can assign a premium, again, a reasonable premium based on where comparables are trading today. And even then, the best case scenario is we have a top range price to revenue ratio of 2.6%. Now this would yield a price of $6.30 for Wendy's, which is still below where it trades today. And it's even worse for EBITDA. The best case is $2.18. So again, there's really no upside to this company, no matter which way you look at it, unless you believe there is going to be a takeover or a refinancing in the coming months. Now, for my gamblers in the audience, this is a trade that I would take short in my younger days. Right now, I can't afford to take as much risk and be that crazy with my account. I have to be more responsible. But still, if you are on the high risk appetite side, stick around because we're going to break down some of the quote unquote technicals for Wendy stock. So right now, if you do want to take this trade on, I want you to keep in mind the ranges of returns per day that you can expect in this company, right? So on an average basis, right, you can expect a negative 0.5 to 0% return that has a 12% probability, and on the upside, a 1% to 1.5%. But of course, we have to worry about the tails. One tail to the negative side is between 1.5% decline to 2.5%. And then on the upside, it's pretty much distributed between 1.5, 2.5, and then 2.5 and 4.5. And you can see pretty much the return distribution in a histogram here. That is going to come useful if you do decide to risk any capital. That at least gives you some sort of daily expectation and whether you fall outside of it. So now talking about volatility, we could see that Wendy's has been expanding on volatility since roughly September of this year. So again, we should expect a contraction in volatility, and that isn't great for a short position, right? You must wait until volatility contracts to a level where an expansion is about to come around the corner. And that way you can take advantage of the volatility and the fear that might come around Wendy's stock for you to put a short position. Now, speaking about volatility, you can see the recent expansion and breakout on earnings and the severe contraction in volatility, which again might inspire some institutional buyers to come in. And that would be essentially the risk to you if you want to take this trade short. If somebody comes in and buys on that volatility contraction, it would depend on how much and who is buying, because that could tell us someone has information that we don't have when it comes to a potential takeover, a potential refinancing of Wendy's debt, which again would turn that terminal value being negative to a positive, give the company some upside, and then ruin your entire trade. Now, while this particular trade and opportunity is not something that I'm taking on for the Investor Brew portfolio, I do want to remind you that we're putting out about 3 to 5 deals every single week when it comes to long short equity, value investing, and overseas opportunities, all within our WhatsApp deal room. Again, you can get 7 days for free right now in the link below. I hope to see you there, and I hope you get a lot of value out of this. Enjoy those Frosties while they last. And I guess we'll see by 2030 if the debt comes due and Wendy's goes bankrupt then or even before. It's been an absolute pleasure, and I'll see you guys in the next one.